Retirement's not always the sexiest thing to be talking about, especially in your late 20s. I don't really know anybody going to parties talking about, hey, you want to learn about my 401k? But jokes aside, you should be thinking about your 401k and retirement as early as possible so that way you can save the most amount of money. Imagine waking up in the future and your account shows over $1 million and all you did was contribute a small amount of your paycheck every single month. But how did it rise so high? Well, that's the beauty of a 401k, and in this video, we're going to be talking about the pros and cons of a 401k. So let's talk about what a 401k is. A 401k is a retirement plan that allows you to take a section of your paycheck and allocate it towards a long-term investment. In a traditional 401k, that money is pre-taxed. So you'll have a pre-tax amount go from your paycheck into your 401k. Now this money taken off will actually lower your taxable income, but you will have to pay taxes on it in the future when you withdraw it. Now this money going into your 401k plan is invested into stocks, mutual funds, bonds, and other assets. And remember, this money isn't taxed until you take it out, so it's sort of growing in this tax-free environment and compounding. Now the caveat is that you can't touch this money until you're 59 and a half, and if you do, then you get a 10% withdrawal penalty. There are some exceptions, and we'll discuss that a little bit later in the video. Now the word 401k comes from the section 401k of the Internal Revenue Code. This section states that an employee can avoid being taxed on direct pay if they instead elect it as deferred compensation. The great thing about 401ks is that they're automatic, so you don't even have to think about how much you have to take out for your retirement or how much you have to put into your account. It's taken off of your paycheck. One of my favorite things about 401ks is employer matching. This means in addition to your contribution, your employer will also add to your 401k. Now you might be wondering, what's in it for my employer? Why would they just give away this essentially free money? Well, besides being attractive for recruiting new employees to that company, it also offers tax benefits for the company. So it's a win-win. So let's go over an example here. So I have a calculator here. I'm going to put in some numbers to show you how much you can actually earn with a 401k with compounding interest. So let's say you're 30 years old and your employer matches dollar for dollar up to 6% of your pay. So if you make $100,000 a year and contribute around $833 a month, which is about 10% of your paycheck, that 6% match means that no matter how much you put into your 401k, your employer will contribute a max of 6% or around $6,000 by end of year. That's assuming a dollar to dollar amount, but some employers offer something where it's like 50 cents to a dollar. So in that case, instead of getting $1 for every dollar you contribute, you'd get 50 cents for every dollar you contribute, which would cut that amount in half. So you'd actually only get 3,000 in that case instead of 6,000. But for this example, let's just stick with the 6% match, and they're doing dollar to dollar. So in this example, you're basically contributing $10,000 by end of year, right? Because it's 10% of your salary. And your employer contributed 6% or $6,000. This gives you a grand total of $16,000 contributed into your 401k. Now in this equation, we're going to take out any sort of salary increase. So your salary is going to stay at 100k for 30 years, which means that every year you're pretty much contributing $16,000 into your 401k total. Now remember, the money that you have in your 401k will be going into index funds, mutual funds, some stocks, some bonds. So let's assume that the market has a 7% year over year return. So basically with everything compounding and you making those $16,000 yearly contributions, you're looking at $1.6 million in 30 years. And keep in mind that you will have only contributed $300,000 over those 30 years, and your employer with that 6% match will have contributed around $180,000. So even though over the course of those years, $300,000 left your pocket to be contributed to your 401k, the compounding interest over time nets you $1.6 million, which is just nuts. How this works is, let's say that you have $100,000 in your 401k account, and let's just say that you don't make any contributions and that you're getting that 7% market return year over year. And again, let's just assume that that 7% return is happening year over year for 30 years. Then what's happening is that first year into your second year, your 100k rises by 7%. 7% of 100k is 7,000. So that second year going in, you have $107,000, right? But then you get 7% of $107,000, which is more than $7,000. So now your account grows to $1,114,490. Now keep doing this over 30 years and it actually becomes $761,225. And again, this is assuming that you have no contributions into your 401k. This is just the compounding interest over time for 30 years. You see the power of maxing your contributions and making sure that you put as much as possible to your 401k? The government also likes 401ks because it allows people to put retirement into their own hands, so that way they don't have to be using welfare or other sort of government assistance programs, and they can manage their income themselves with their own money. Now this sounds amazing, right? So why doesn't everybody just take 50% of their paycheck and just max out and put as much as possible into their 401k? Well, the reason is because there's a limit to how much you can put every single year into your 401k. Now this limit changes every single year, so I'll link to the IRS documentation where you can find the most recent limit. I believe for 2021, the individual contributions from any person was about $19,500 for that year, which is 2020 and 2021. But there's an important distinction between how much you can contribute and how much your employer can contribute. And that's something that I didn't know until much later on, which is really important. So in 2021, for an individual, you could have contributed, $19,500 for the whole year, but your employer can contribute a lot more than this if they are that generous. Your employer can actually add $38,500 on top of your $19,500 for a grand total of $58,000 a year into your 401k. Most companies are not this generous, but it's just important to know that. So in case you do get some crazy offer where they're giving like 150% match or 200% match, you know how much you can actually be getting for your contributions. As mentioned earlier, the money that you put into a 401k is put into index funds, mutual funds, bonds, cash, stock. Depending on your risk tolerance, you can choose different types of investments. So if you're younger, you might want to put more into stocks. And if you're older, you might want to put more into bonds. But what's interesting is that some of these investment advisors or accounts have what's known as a target date retirement fund. You might have seen one like Vanguard 2065. And so that number 2065 represents when the fund is really going to start to convert and mature. These funds are great because depending on the years remaining, they automatically adjust from more risky investments like stocks to safer investments like bonds. Take a look at the composition of Vanguard 2025 versus Vanguard 2065. Notice how heavy 2065 is in stock, but since 2025 is around the corner, this fund is more evenly distributed into bonds. Now, when most people set up a 401k, it's usually traditionally set up as a traditional 401k, hence the name. It works pretty well because again, it's an immediate tax benefit. If you get $1,000 on your paycheck and $100 goes towards your 401k, the IRS really sees your income as $900 because that $100 is given as a break until you have to actually pay taxes on it when you withdraw it from your 401k in the future. But the thing is, taxes change. They could be much, much higher in the future or much lower. We don't really know that. For example, did you know that in 1963, there was a 91% tax rate for certain high income earners? And in 1944, there was a 94% income tax for certain types of income earners. Enter the Roth 401k. With a Roth 401k, you pay taxes up front, so that way when it's time for retirement, you don't pay any taxes at all on your withdrawal. This is useful if you envision your tax bracket being higher in the future, or if you envision that there might be higher tax laws in the future. Now, it's important to note that you could have both a traditional and a Roth 401k, so you could technically, for example, max out your employer contribution on your traditional 401k and then put the remaining amount to reach your limit into the Roth 401k, for example. Personally, I'm putting more into my Roth 401k because I'd rather take the brunt of taxes now and then pay no taxes in the future. Well, no taxes on my Roth withdrawals. You always got to pay taxes somehow, but you understand what I'm trying to say. Just know that both traditional and Roth 401ks have that 10% penalty as well as other types of fees. So if you take out money from your Roth 401k early, even though that money is already taxed, you're going to be hit with a 10% fee, which really sucks. So be sure that if you do that, you're not going to be touching that money until you retire. One other area is that you could technically take out a loan from your 401k and then pay it back without any sort of penalty. But again, due to the fact that you saw the power of compounding interest, I really would not advise touching your 401k for a loan because you're really doing yourself a disservice by taking out that money early. Even though you're paying it back, that's money that could be growing. You're basically your nest egg. So you don't really want to disturb that until it's time for retirement. Now, I've talked a great deal about the positives of a 401k, but let's go over some of the cons of having a 401k, whether traditional or Roth. Number one is you can't touch the money, and you really shouldn't until you're 59 and a half, or you'll receive a 10% withdrawal penalty plus income tax, except for certain rare cases like medical emergency or if the owner becomes disabled. For those that are older and closer to 60, you will need to be contributing to the account for at least 5 years before it's really eligible for withdrawal. The second con is that there's a limit to the contribution. So obviously you can't contribute as much money as you want. There's a limit per year of how much you can put in. Number three is for traditional 401k. So you might actually get taxed higher if you have a traditional 401k and take out a large income, as this may put you into a higher income bracket. The fourth con is that your investment choices are limited. As I mentioned before, you can't go all in on AMC or buy some crazy stock. You have to be buying mostly index and mutual funds for your 401k. For more aggressive trading and management of your account, I recommend a Roth IRA, which I'll cover in a separate video. And the fifth one here, which isn't necessarily a con or drawback of a 401k specifically, but it's important to talk about, is inflation. So inflation is a problem because it makes our money less valuable. And the issue is that if we make 1.65 million in 2070, it's not going to be as valuable as it is now in 2021. So it's important to save for retirement, but just know that the money that you're actually making won't be as valuable in the future as it is right now. Many of my watchers are young adults, and while 60 years old might be super far in the future, it's important to think about how you're setting up your retirement plan, and especially how much compounding interest can make you over your lifetime. Thanks for watching. Please don't forget to leave a like and subscribe if you learned something or found this video useful. It really helps my channel to grow and for YouTube to recommend my video to new watchers. And as always, keep on making great trades.